Hi folks, welcome to this video on installment notes. Now, when we're recording an installment note, one of the important things to realize is that installment notes are generally long-term notes. And you remember in our previous class whether the note, even though the note is long-term, whenever we have any interest that we're calculating as receivable, it's included in the note itself. So we don't have a separate entry to record any interest receivable if there was an intervening year end. But specifically to installment notes themselves, payments are made on an installment basis, and the payment is going to include two parts. It's going to include interest that you've charged your customer and any principal repayment. So with every payment that you get from your customer or your related party, whatever it is, those amounts are going to be reflected in that one lump sum payment that you're getting every period. So that payment's going to include any interest and any principal repayment on the note. But you do need to have the market or implicit rate of interest that's being charged on that money that you're lending out in order to book your interest revenue. So if we have a look at our first example here, you can see in this example it says, assume that company A sells goods to B for $10,000. So first of all, $10,000 is going to be the present value of your note. So you can set the note up at $10,000. But you also know that A has decided to accept from B 2886 payments of $2,886 every 4 years. So in other words, they're going to allow them to pay off this note over a 4-year period at $2,886 a year. If you multiply 2886 times 4, you'd know that that gives you more than $10,000. So we already know there's going to be interest included in those payments. But what we need to do in order to calculate the amount of interest revenue that B is going to be booking every time they get a payment of 2886, we need to do a calculation to determine our I/Y, or our interest rate. So therefore, to calculate that interest revenue, I'm going to take my present value, which is $10,000, and again it's a plus minus because the client or the customer isn't paying me right away. So I'm basically giving them a product of some kind and not getting payment. So that's an outflow for me. I'm giving them something. So I just make it a plus minus, or to make it negative. That's my present value. And notice here my future value is 0. That's different than any of the other notes that we had before, because when we were dealing with discount or even premium notes, what we would find is that at the end of the period, there would be a lump sum payment to be made back to, say in this example, company A. But now we're not going to do it, because don't forget, every time a payment is made, it's not interest only, it's not principal only. In this case, every payment that's made is going to include a return of the principal on the note. So our future value is going to be 0. The payment is going to be an inflow, so we just put it in as 2886 PMT. The number of payments we get are 4. So if we did a compute I/Y, we get 6%. So now in order to calculate the amount of interest revenue we're going to book every year, I just set up a table. And the table is going to make it easier for you to actually record, or make your journal entries to record the interest. So with the issue date, which is the beginning of year 1, I didn't receive any cash. I have no interest revenue to book. None of the notes been amortized. The note receivable is sitting at its net value of $10,000. But now, at the end of each year, every time I receive 2886, some of that 2886 is going to pay off the interest, right? So, and it's also going to pay down part of the note principal. So in order for me to calculate, you'll see I have a little number 1 here. So what I've done is I've used this interest rate of 6% to help me calculate the interest. So if you just look down here, I'm going to skip down here, you'll notice that, I wonder if I could just cut and paste this. Oh, I can't. Maybe I can copy it up here. No, I guess I can't. Anyway, you'll notice that every time I'm calculating my interest, right? It's going to be what? It's going to be the note receivable at its net value to open year one times the 6% that I calculated here, which is going to in the first year give me $600. So if $600 is the amount of interest revenue that's included in the 2886, then 2886 less 600, which is 2286, must be the amount of the note that's being paid down. So therefore, if the note was valued at $10,000 at the time it was issued, less 2286, that means that the carrying value or the value at net of the note is going to be 7714. So now when I'm calculating how much of the note is being paid down with the second payment of 2886 at the end of year two, the first thing I'm going to calculate is how much interest is included in this $2,886. And I can get that by taking 7714 and multiplying it by 6% to get $4,683 as the amount of the interest included in that cash payment that I've received. So again, you can see it down here. I've taken the face value of the note to open this to open year two times the 6%, which was my implicit rate. All right. So when I do that math, I get 463. So the 2886 is covering 463 in interest, and the difference is 2423, which is the which is part of the payment that reflects the return of principal or the return on the note. So now my note receivable is sitting at $52.91 at the end of year two. So for me to calculate for year three how much interest revenue is included in the 2886, I'm going to use the $52.91, which was the note receivable value to open year three, and multiply it by my I/Y, my interest, which is 6%, and that's going to give me interest revenue of $317. Well, that $317 is part of the 2886, so the difference between the cash received and the interest revenue that's part of that cash received must be the amount of the note that's being paid down by Company B. So that means Company A is now going to show a net note receivable at $2722, and they're going to use that amount, which is the receivable to open year four, multiply it by 6% in order to calculate the amount of the interest revenue, which is $164, that's included in this 2886 payment. So again, 164 is equal to 2722 times the 6%, which is going to give me 164. So the difference between the amount of money that I'm getting, A is getting from B, which is 2886, the difference between what they're getting and the amount of interest that's included in it is going to be the amount of the principal that's repaid on the note, and we can see now that the note receivable is going to be 0. So this is different than the other notes we've seen. With the other notes, what we've noticed is that the receivable has gone up. It's gone from 10,000 or from one value, the present value, to a higher value because those were discounted notes, right? Here and then we pay back the principal amount of the note based on the face value. Here you'll notice when we make our journal entries for the note, what do we notice? We notice every year A company is booking cash, which is going to be equal to the amount of the payment they get from B. They're going to be booking interest revenue, which we've calculated based on the carrying value of the note to open each year, times the 6%. So the difference has got to be the amount by which, in this column, we said the receivable is shrinking by. Because again, each payment is giving you back interest that you've earned plus reducing the note. So you're getting back part of the note payment, right? So in this case, what does that help us to calculate? That also helps us to calculate what's on the balance sheet. Because at the end of year one, you'll notice in the non-current asset section, and again, it's non-current because in year one, we're still a few years away from year four. It's non-current, and your receivable is sitting at its net value, which is $77.14. At the end of year 2, the note is still non-current, but it's going to be sitting on your balance sheet in the non-current assets section of 5291. Notice now when we get to the end of year 3, your note is sitting at 2722 at net, but don't forget at the end of year 3, year 4 is the end of the note, so now we've reclassified it to a current asset of 2722, and then with the last payment of 2886 that we get, you'll notice that 2722 of it is paying down the balance of the note. So at the end of year 4, you wouldn't have a note receivable. So that would conclude, or that would mean, in other words, you don't need an entry like we had in previous long-term notes that were not installment based. We didn't need an entry to debit cash 10,000 and credit the note receivable 10,000. We don't need that kind of an entry here, because with every payment we get, the principal of the note is being paid back to us. So we don't have any other entry to make at the end of year 4, and that's reflecting the fact that the installment note receivable at the end of year 4 is 0, because again, every time we got 2286, it was paying back part of the note. Okay? So now, if we went to our second example, it varies a little bit here. Not a lot, but just a little bit. In this example, what's happening? Here we have a situation whereby A sold goods to B that were valued at 10,000. They're accepting the same payment from B, 2886. The note is still a 4-year note. The only thing I changed here, just to give you an idea of how the table looks a little bit differently and the entry at issue date is different for A, is that B decided to give A a down payment of 1,000 when the note was issued. All we're saying here is that the value of the goods that were transferred from A to B were 10,000. So your note, so the cash that A received, okay, so the sales revenue is still 10,000. But don't forget, the note receivable is now not 10,000 as it was in example 2 or example 1. It's now 9,000 because A received a cash payment. So now if we're calculating the effective rate of interest charged by A to B, we're now looking at the present value of 9,000, not 10,000. Our future value is still 0 because that 2886 is still going to reflect B's payment to A that pays down the note. We still have a PMT of 2886. We still have a number of payments of 4, and a compute IY gives us 10.76%. So I've only rounded to 2 decimal places here. So now the only difference in the table is going to be the amount of interest revenue that's being booked by A. Because now, when we're calculating the amount of interest revenue for year 1, we're going to take the receivable value at the beginning of year 1, which we've already set up here as 9,000, right, in our entry. And we're going to multiply it by our I/Y, which is 10.76. So you can see here that 9,000 times 0.1076 is going to give us $968 in interest revenue that we've booked. All that means is that of the 2886, 968 was interest, so the difference 1918 is going to pay down the note. So the note receivable at the end of year 1 is going to be 7,082. If we take that 7,082 and multiply it by 0.1076 to calculate our interest revenue, that's going to give us 762. So now of this 2886 payment, 762 pays down interest, but what's left in the note is 2124, and that was the amount of the note that was being paid down with this payment of 2886 in year 2. So now your note is not 7,082, it's 7,082 less 2124, because that was the amount included in this 2886 payment in year 2. So now your note is 4958. We'll use the value of the note to open year 3, which is the same as this value to end year 2, 4958, and multiply it by our I/Y, which is 0.1076, in order to get interest revenue of 533. So in this 2886 payment, if 533 is interest, then the note that's being paid down, the note principal being paid down, is 2353, and that gives us 2606 as the amount of the note left to be paid down. So in the next payment, that we get 2886. If we do our calculation, so there would probably be some rounding involved here, but in any case, we're calculating 2606 multiplied by our interest rate, our implicit rate, and that will calculate $280 in interest that's included in this 2886 payment. So that means that 2606 of this 2886 payment is paying down our note receivable, so we have nothing left in the note. So again, as we saw with example 1, you can see that in each year, if we check the table, you can see that in each year where we book 2886 in cash, if we're a company, every year that payment includes interest revenue, which has been given to us in this column here of our table. And it also includes a repayment of part of the principal on the note, so we're crediting the note. So every time we take in a cash payment, unlike our previous examples of discounted notes, in this case, every payment is not just giving us interest, it's also paying down part of the note. And that's why we have nothing left in the note by the time we get to the end of year 4. Right? So now what's going to happen is if we look at the balance sheet, again, just as we saw in year 1 and 2 in example 1, because the note isn't due till the end of year 4 to be paid in full, every time we have our note receivable in our net column here, the note receivable at the end of year 1 and the end of year 2 is going to be non-current, because we have 4 years to go until it needs to be paid in full. But now when we get to the end of year 3, from the end of year 3 to the end of year 4, that's within a 12-month period. So you'll notice that whatever the note receivable is at net at the end of year 3, we have that here, that's going to be reclassified now as a non-current asset, or a current asset, I should say. So we're going to have it now as a current asset at net of 2606, and with our final payment of 2886, it's repaying the note principal that's left, so you have nothing left. So here we would show nothing in the note receivable. So in essence, we wouldn't have anything in the current asset section for the note, because that would be fully paid back with our last payment of 2886. So this concludes our discussion on installment notes receivable.